if you have paid attention to the mutual funds that you're investing in, then you will have seen something called a Riskometer. It's kind of like a speedometer with an arrow pointed in certain directions, and it tells you how much risk a particular mutual fund scheme is supposed to take. How is this determined, and how do you differentiate between various schemes that all are classified as very high risk? Because practically all equity mutual funds are designated as very high risk. I'm joined today by Nasser Salim, who is Managing Director of Flexi Capital. Thanks so much, Nasser, for taking the time, and I think this is a fascinating conversation to have. So first of all, how do you understand this Riskometer and the various readings that it might throw up?
Good afternoon. Thank you very much, Alex, for having me on your show today, and to all your viewers. So a very key, important, pertinent point you've raised. Riskometer, is an attempt, in all earnest, by the regulator, in this case, Alex, where it's introduced by SEBI and it's implemented by AMFI, which basically helps investors quickly understand the risk level of a particular scheme that they invest in, right? Broadly, it displays, it's like a speedometer, as you rightly said, style dial, Alex, showing where a fund falls on the risk spectrum, broadly from low all the way to very high, right? And you can think of it in a normal parlance like a nutritional label for funds, right? It doesn't tell you whether a fund is good or bad, but it clearly tells you how risky it is in terms of upfront and in a uniform format. I think that is something which is very, very important in a Riskometer. And I think it was introduced because earlier labels like just equity in a particular mutual fund or debt in a particular fund didn't capture how different risk profiles could be within those categories. So I think it's a very simple depicted Riskometer, speedometer style, which tells you by and large which spectrum of risk does the particular fund fall in.
And you've described it very well, but here's my question, right? So, and we've been talking, I was speaking about gold earlier, Nasser, and I was looking at the fact that 24,000 crore rupees pouring into gold ETFs. And by the way, they have been designated as high risk. Equity is designated as very high risk. So there is just a shade, according to the Riskometer, just a shade below very high risk. There is a considerable amount of risk investing in gold as well. So when you look at equity specifically, the fact that practically everything is in very high risk, how do you differentiate between the various categories?
So again, very pertinent question again, Alex. There, I think it's true that most equity funds, Alex, fall under the very high risk category because equities by nature are volatile, right? Now, usually SEBI has used, broadly, I'm saying SEBI is because they're the ones who kind of masterminded this entire thing of Riskometer. They use a standardized framework, right? Where the Riskometer band depends, as I told you, on various risk profiles. So investors need to look deeper. Now, predominantly, what SEBI has been talking about and mentioning this is when you're looking at the various Riskometers, it captures market cap, composition, category discipline, and portfolio characteristics of a particular fund, right? And that is what is the main distinction between the various risks that are assigned to a particular fund or an asset class for that matter. You spoke about gold. People usually understand that gold, they have a misnomer that gold is very, very safe. It is very safe in the long run, I must tell you, but it can also deplete your fundamental capital value in very shorter periods of time. So therefore, I think it's very important, the three main important parameters here, when you look at the risk tolerance band for equity funds and the other broad asset classes, I think it's very, very simple. Small cap, for example, inherently will carry higher risk than a mid cap and a large cap. Similarly, if stocks are trading in low volumes, the liquidity risk also increases. So therefore, if funds are holding stocks with higher price fluctuations or higher underlying assets which are fluctuating as compared to some of the other asset classes, they may be regarded as more volatile, Alex. And therefore, the fund will then be demarcated as a very high risk category, yet one, again, something which could be more stable in terms of a large cap. Yeah. A large cap has enough liquidity, doesn't fluctuate so much in terms of the underlying stocks that it holds in a fund. And that could obviously carry a little lesser risk as compared to a pure small cap or a particularly higher volatile asset class, which is where the fund is being invested into.
Ultimately,
so
you're trying to... Yeah, you're trying to put all of these factors into play when you're trying to read the risk associated with it. It's like if you're talking about the ingredients, like you said, it's a label. Then the label at the top is effectively the riskometer, and then it's up to you to look at the fine print and to understand whether the components of what you're eating is going to be okay for you. And you need to know, therefore, that you are possibly allergic to a certain type of nut, and you don't eat whatever is in that mix that you've picked up, right? So with that example and taking that forward, I do want to ask you about standard deviation, because a lot of people use standard deviation, which is a measure of volatility, and they use it in conjunction with risk. And they say, okay, you can broadly judge how risky something is to hold when you look at the standard deviation. Is this appropriate? First of all, how do you look at standard deviation, and is this appropriate?
Alex, standard deviation plays a very, very pivotal role in our lives as as specialists in terms of distribution of funds and recommending and using that as a tool for our clients. So broadly, to all your viewers, a standard deviation is nothing but a measure, Alex, of how much a fund's returns fluctuate from its average return over a period of time. As simple as that, not very complicated. In simpler terms, it tells you how volatile or unpredictable a fund possibly, maybe, or has been historically. So therefore, a lower standard deviation indicates it to be more stable in terms of returns, right? So that's the first broad important point. So when you're looking at standard deviation, which is for comparability, a standard deviation is good for comparing volatility between similar funds. That's the second very important point. So like two large cap funds or two hybrid funds, a standard deviation is beneficial. So you can't compare a standard deviation of a large cap fund, for example, with a small cap fund. I mean, you have to compare apples to apples, right? So SD is beneficial when identifying aggressive and stable strategies, and hence also understanding the returns consistency. I think that is very, very important, Alex. And the other one, I think, can standard deviation be looked at in isolation? Standard deviation alone looks at historical volatility and does not explain where the volatility can come from market movements or funds or fund managers' decisions. I think that is something which is very, very important for you to note. How the fund behaves relative to its benchmark, or whether volatility was positive or negative. I think a standard deviation is just another supporting metric in the analysis that we put out for a lot of our clients, and not a standalone decision tool again, Alex, which is the most important part. I think it does help you evaluate alongside other risk and performance measures in a particular fund.
Yeah, there's a reason why they say, prior performance is no guarantee of future returns in the mutual fund space, because a lot of these metrics, Nasser, are backward looking, and you're trying to gauge based on how a fund has performed in various market cycles, and based on these metrics, whether it's likely to outperform or underperform going forward as well. But having said that, what are the other measures very quickly that you look at, not necessarily going into too many details, and then we'll talk about perhaps the most important to focus on for the investor?
So Alex, a combination of the other metrics that we use to gauge risk in any particular fund broadly, and are a combination of all of these. So it starts with standard deviation, we just discussed. And there's something called beta. It's again a very popular mix, a statistical tool that we use for gauging performance and risk. Risk, more importantly. I think beta is basically quantifies how a fund moves in returns with relation to its benchmark, right? So a beta of 1, broadly, we'll use the benchmark of 1 as in the number 1. A beta moves in line with the market, that's what it indicates. Anything beta of less than 1 is greater than 1, pardon me, is more volatile than the market index in this case, and anything less than 1 is less volatile than the market. So I think, what it does is it tells you how is the fund's returns in relation to the benchmark, right? That's one important factor. The other one, of course, is alpha, which measures the excess returns generated, Alex, over the benchmark, right? A positive alpha obviously implies their outperformance over the benchmark, and therefore it's a very important risk parameter. We also use something called the Sharpe Ratio. A lot of mutual fund managers talk about Sharpe ratios in their discussions. I think Sharpe Ratio is, again, it measures the risks-adjusted return. So a higher Sharpe Ratio means the fund delivered better returns for the amount of risk taken. So, we compare it to risk-free returns, and what is the return of the fund as compared to the risk-free return. That's, again, the risk measure that we use. Something very popular, again, is Sortino. Sortino is a fund risk-adjusted return by focusing on downside risk, which is basically focuses on negative volatility. Higher the Sortino ratio, the better the fund is considered. So a combination of standard deviation, alpha, beta we spoke about, Sharpe, Sortino, and then of course, in hybrid funds, Alex, there's also a combination of credit risk, interest rate risk, and liquidity risk. Because all of those as well play out a very, very important barometer for risk assessment.
Absolutely. And so the earlier ones that you spoke about are primarily equity-related risk measures. And you were mentioning that it's important to also look at risk for credit funds or for debt funds, and certainly for commodities as well, for gold and silver. You will generally see that the standard deviation is pretty high. So bear that in mind. Nasser, I think we've kind of elucidated this pretty well, or we've described it pretty well. We've got lots to talk about, and I think we'll delve a little deeper perhaps into hybrid and into fixed income funds at a later date. But thanks so much for joining me today.
Thank you.